Hello students, welcome to Accounting Explained at Accountwise Academy. This is Latha Venkateshwaran. My dear students, before proceeding to the provision for depreciation method, now let us have a brief recall of the straight line method formula. This I have covered elaborately in my previous video. Please go through that video for a better understanding. Now let us see the formula for straight line method. The formula is depreciation per year is equal to cost of the asset minus residual value by useful life, that is in years. I am going to take an example and teach you how to calculate depreciation per year for the straight line method. The same example I had taken in my previous video also. Okay. So cost of the asset here is 2 lakhs. Residual value is 20,000 divided by useful life is 10 years. So you get 1,80,000 divided by 10 and depreciation per year, that is annual depreciation, will be 18,000 rupees. Now let us move on to the method 2, that is provision for depreciation account. In this, asset remains unchanged at original cost. That is, anytime if you see the asset account, you will see only the original cost of the asset. Second, depreciation will be recorded separately as a provision. Depreciation is not going to be taken to the asset account. Instead, a new account called provision for depreciation account will be opened and all the depreciation will go to that account. The advantage of this is it improves clarity in financial reporting. That is, we keep the asset at full cost, that is original cost, right? And we show depreciation separately in the provision for depreciation account. So, the financial reporting will show a better transparency. Students, now let's solve a question. I am going to take the same question as I had taken for the straight line method of depreciation. And let us proceed with the method 2, that is the provision for depreciation. The question is as follows. A company purchases equipment for rupees 2 lakhs on 1st April 2022. Its useful life is 10 years and the estimated residual value is rupees 20,000. You are going to calculate annual depreciation under the provision for depreciation method and show the first 2 years journal entries, ledger accounts and the balance sheet extract. So first let us proceed for the journal entries for the year 1. We all know the format for journal entries. By now we should be knowing, right? Okay, the format is date, particulars. Here you can include one column called ledger folio and it will have another column debit and credit. Okay, totally you need 5 columns. First you have to pass journal entries for the journal entry for the purchase of equipment for rupees 2 lakhs on 1st April 2022. So on 1st April 2022, equipment is an asset. When you buy an asset, the asset value increases. So equipment account has to be debited. Equipment account debit on the debit side 2 lakhs to bank account because we are buying through bank. Bank balance is going to be reduced. Asset value is going to be reduced. Since the bank balance is going to be reduced, it has to be credited. Okay, 2 lakhs. Next, we have to pass journal entry for the depreciation. What did I tell you? That depreciation will be taken to the provision for depreciation account, right? Unlike in the straight line method, we took the depreciation to the asset account. Here, we are not going to take it to the asset account. We are going to take it to the provision for depreciation account. Come on, students, I will explain you the journal entry now. So, it will be passed on the year end. So, year end is March 31, 2023. We all know depreciation is an expense. It is shown as an expense on the debit side of the P&L account, right? So, all expenses should be debited. You debit depreciation account. First year depreciation is original cost less residual value divided by useful life. That is 1,80,000 divided by 10, which is equal to 18,000 is the annual depreciation. Okay, so 18,000 will be your annual depreciation. It will be debited 18,000. Next, I told you it has to be transferred to the provision for depreciation. This provision is created on the asset. Okay, so the asset value has to be reduced. What will you do with the asset? Asset will usually be debited. So when the asset value is going to be reduced, you are going to credit it. So provision for depreciation now will become a liability or it will be reduced from the asset. So it has to be credited. No provision for depreciation 18,000. Okay, next depreciation has to be transferred to the P&L account. So March 31, 2023, P&L account debit. First I'll explain you the depreciation here. Depreciation is debited. So when you're going to cancel this depreciation, what you're going to do, you're going to credit it to depreciation account 18,000. So this depreciation is going to be transferred where? To the P&L account. So now P&L account has to be debited 18,000. This is the flow of the journal entry for the year 1. Now let us move on to the year 2 journal entries. In the year 2, we have not made any purchase. So it is enough if we pass a journal entry for depreciation and transfer it to the P&L account. Year 2 ending date is March 31, 2024. First, we will pass the journal entry for depreciation. Depreciation is an expense, so it has to be debited 18,000. Here, we are following straight line method of depreciation. Under straight line method of depreciation, uniform amount of depreciation will be charged, or the same amount of depreciation will be charged every year till the useful life of the asset. So here 18,000 will be charged every year till the useful life of the asset, that is 10 years, end of the asset. Okay. Again, next, provision for depreciation is created on the asset and it will reduce the value of the asset. So it has to be credited to provision for depreciation 18,000. Next, on the same date, that is March 31, 2024, depreciation has to be transferred to the profit and loss account. Here, in the original entry, we have debited the depreciation. Now, we are transferring it to the P&L account. So, it has to be credited to depreciation account 18,000 and it will be transferred to the P&L account 18,000. Students, if you notice here, I have not written the narration. By this time, you should be very confident to write your own narration. So, in the exams or when you practice, don't forget to write the narration. It is very important. Only if you write the narration, you will get the full marks for the journal entries which you have passed. Okay. Now, I want to ask you something. If you like my video so far, give a thumbs up and subscribe to my channel, Account-Wise Academy. This will encourage me to make more videos like this in the future. As per the question, we have passed journal entries for the 2 years. Now, we have to do the ledger posting. For the ledger posting, first we will open the equipment account. Okay. So these are all the journal entries for the first year which we have passed, and this is journal entry for the second year we have passed. So let us do the ledger posting now. So if you see here in the first year on April 1, 2022, we have passed the journal entry equipment account debit to bank account 2 lakhs, 2 lakhs. Right. Now here in the journal entry we have credited the bank account. So in the ledger of equipment account, we have to debit the bank account on the same date, April 1, 2022 to bank account 2 lakhs. There are no other journal entries that pertains to the equipment account. Okay, so this account will be closed for this year. So 2 lakhs balance will be taken to the credit side also. Now on March 31, 2023, we will write by balance carried out 2 lakhs. Again, it will be brought forward on April 1, 2023 as 2 balance brought down 2 lakhs. So there are no other journal entry pertaining to equipment. So this can be balanced. On seeing, we see the debit balance is more. So we take the balance of 2 lakhs on either side. Again, on March 31, 2024, we will write as by balance carried out 2 lakhs. This is how you are going to prepare the equipment account. Next, we will open provision for depreciation account. If you see the journal entry on March 31, 2023, depreciation, it is depreciation account debit 18,000 to provision for depreciation account 18,000. Here in the journal entry, we have debited depreciation account. So in the ledger of provision for depreciation account, we are going to credit it. March 31, 2023 by depreciation 18,000. In the first year, if you see the journal entries, there are no other journal entry or provision for depreciation account. So this account has to be closed. I told you that provision for depreciation account is created on the asset. That is, the asset value will be reduced. So this provision for depreciation account will be taken to the balance sheet. When the items are taken to the balance sheet, then we will not close the account. We will just show the balance. So here also provision for depreciation account is like a liability account. What did we see previously in the equipment account? We did not close the equipment account by transferring it to the P&L account. We just took the balance. Okay. We wrote the balance carried out or balance brought out. Similarly, provision for depreciation account also, balance will be taken. Okay. It will not be closed. It will not be made as zero. So now if you see on the credit side, balance is more. So we will take that total to the debit side also, 18,000, 18,000. On March 31, 2023, the balance will be 2 balance carried out, 18,000. Again, if you see, this balance will be brought forward on April 1, 2023 as 2 balance brought down 18,000. Okay. The other name for provision for depreciation is accumulated depreciation. Every year, depreciation will be accumulated as and when we are going to charge it to the asset. That is the end of the year, and it will show a balance of depreciation accumulated throughout the life of the asset. That is the meaning of provision for depreciation account. Okay. So on March 31, 2024, that is the second year, we have passed the journal entry on provision for depreciation. Here, depreciation account is debited rupees 18,000. So in the ledger of provision for depreciation, it will be credited March 31, 2024 by depreciation 18,000. On seeing, you see the total of the credit side is more. So if you total the credit side, it comes to 36,000. Take it to the debit side also. On March 31, 2024, it will be written as 2 balance carried on 36,000. See here now, 2 years depreciation is accumulated here. Now the depreciation has become 36,000. So you all should remember, students, that another name for provision for depreciation account is accumulated depreciation account. Okay, if in the exam, if they ask you instead of provision for depreciation account, do provision accumulated depreciation account, then you should not be confused. You should do as we do for provision for depreciation account. So the next account which we are going to open now is depreciation account. On March 31, 2023, we have passed the journal entry for depreciation. Depreciation account debit to provision for depreciation 18,000, 18,000. Here, in the journal entry, we have credited the provision for depreciation. So in the ledger of depreciation account, it will be debited March 31, 2023 to provision for depreciation 18,000. Again, on March 31, 2023, we have passed the journal entry of P&L account debit to depreciation account 18,000, 18,000. Here P&L account is debited. The depreciation account, it will be credited March 31, 2023 by P&L account 18,000. If you see, both the debit side and the credit side are tallied. So there is no balance to be carried out. 18,000, 18,000. Depreciation account is a expense account. All the expenses account and the income account will be closed. That is, it will be transferred to the P&L account and these expenses account will not be taken to the balance sheet. This you have to remember. And again, I'll tell you, all the assets account and the liabilities account will have the balance, and those balances will be carried on to the or will be taken to the balance sheet. This you have to remember. You should not forget, because when you start doing the final accounts, these things matters a lot. Okay, coming to the second year. Same, here depreciation account 18,000, 18,000. Provision for depreciation account is credited. On March 31, 2024, in the ledger of depreciation, it will be debited to provision for depreciation 18,000. Again, on the same date, we have passed a journal entry to transfer it to the P&L account. Here, P&L account is debited. So, in the ledger of depreciation account, it will be credited March 31, 2024 by P&L account 18,000. Both the debit side and the credit side total are the same. So, the account is tallied. There is no balance, nil balance. As asked in the question, we are going to do the balance sheet extract for year 1, that is March 31, 2023. So on the left side it is liabilities, on the right side it is asset. On the liability side we have capital and liabilities, other liabilities and total. On the asset side, only the equipment will be taken. Equipment at cost is 2 lakhs. And we had a balance of 18,000 in the provision for depreciation on the credit side. If you want, you can refer to the provision for depreciation account. As I told you, provision for depreciation will be deducted from the equipment account. So deducted from the equipment account 18,000. Now you have a net book value of 1,82,000 in the balance sheet. Okay, coming to the second year. Balance sheet extract for the year to 31st March 2024. Equipment will be 2 lakhs. In the second year, if you refer to the provision for depreciation account, we had a balance of 36,000. As I told you, it is also known as accumulated depreciation, right? So now it will have a balance of depreciation for 2 years, that is 36,000. Now you'll have a net book value of the equipment as 1,64,000. This is how you're going to prepare the balance sheet extract if they ask in the exam. We are going to see a quick comparison between the method 1, that is the direct asset deduction method, and method 2, provision for depreciation account. Okay. First, we will take the asset valuation. Under the direct asset method, the asset account is going to be reduced yearly by depreciation. Whereas under provision for depreciation account, asset is going to be shown at the cost and provision for depreciation will be shown separately. Ledger impact. Asset account will be reduced every year with the depreciation amount. Here, the provision for depreciation method, asset account remains unchanged. It will remain the same, whereas provision for depreciation account will be credited with the depreciation account. Okay, depreciation expense. Here, we are seeing only the straight line method of depreciation. So, the depreciation amount is going to be uniform or the same for the method 1 and the method 2. Let's see a summary of what we have learned so far. Method 2, that is provision for depreciation method, records depreciation separately using provision for depreciation account. Here, asset value is going to be remained at the original cost, and provision for depreciation will have a balance of accumulated depreciation account. Both the methods are accepted and are going to yield same results. My dear students, That concludes our lesson on method 2 of the straight line method. In my upcoming videos, we will explore the return down value method and its two recording options, expanding your understanding of depreciation accounting. Thank you for learning with AccountWise Academy. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.